miners is ultimately they're driven by the economics of the commodity first, and then they're driven by the individual factors involved in that mining company. So, from basically, if you're buying a mining company that's making gold and gold is tanking, doesn't matter how good the company is, it's not gonna do well. So that's the main point I want you guys to get out of this. So I'm going to show you all the basic stuff about commodity economics. There's a hell of a lot more that's in this slide deck, but this should give you a general idea of how to look at and analyze commodity economics. And yeah, hopefully it'll be a good starting point to have a look at. So what we're going to learn is what is a commodity, what are the properties, how to analyze them, and I'm going to give you an example. My example will be oil and gas. And then at the very end, if we have time, we might actually try and do silver together, mainly to stir up all the silver bugs. And the other thing about the commodity economics is you assume that they apply to the resource sector, so oil and gas and agribusiness and mining and things like that. But they actually go further than that, and I'll show you why in a second. So you would know what a commodity is. Most people sort of know the general understanding of what commodities look like. For example, oil, gas, pigs, grain, bitcoins. Bitcoins, but there's some other weird ones like virtual CPUs in the cloud are actually commodities, because if you look at the definition down here, which is straight from Wikipedia, in economics, commodity is an economic good, usually a resource that has full or substantial fungibility. That is, the market treats instances of the good as equivalent or nearly so, with no regard to who produced them. Basically, you don't care what virtual CPU you get, you just care that you get a virtual CPU. So you're not running around going, yeah, I've got that virtual CPU in downtown data center, wherever. So the virtual CPUs are a commodity. It's the same with compute cycles. And insurance is a commodity as well, which is not that clear from the way the insurers actually know this, and what they try and do is they try and make it look like it's not a commodity, but in reality it is. And they do that via marketing and trying to brand their things in certain ways and add certain things to it, but ultimately insurance is a commodity. Cash is obviously a commodity as well. And then this is some examples of what isn't a commodity. So for example, if you build a piece of furniture yourself, that's not a commodity, because you're going to care about the fact that that's your piece of furniture that you built, and it's got some intrinsic value to you, which you won't get by buying, say, a piece of IKEA furniture. Microsoft Windows, as in if operating systems, are not commodities, because you can't swap Microsoft Windows for Linux, for example, easily. So you have to go and buy Windows. And The Mandalorian is not a commodity either, because you can't, you want to watch The Mandalorian. But then you get some other examples which are a bit more weirder, like TV shows on Netflix. And you would go, but TV shows are clearly not a commodity because they're not fungible. But then you look at Reed, can't remember, he's the CEO of Netflix anyway, Reed, can't remember his last name. But he had this quote in one of his talks where he basically said that they switched off a lot of top end content like Disney and Sony and Stars, and they didn't see any drop off in people watching. Yeah, Reed Hastings, that's it. They didn't see any drop off in people watching Netflix, i.e., people didn't care that they couldn't watch all the top end Disney, Sony, Stars stuff. They just cared that they could watch Netflix. And if you think about your own viewing of Netflix, you scroll through Netflix looking for things to watch. You don't go looking for you rarely go looking for a particular TV show to watch and then choose your streaming provider on that basis. So it's potential, and I'm not saying it is fully a commodity, but it's potentially that TV shows are commodities. And you can see that in Netflix content pricing and the budgets they set for TV shows. A lot of the stuff that Netflix is producing is actually pretty low budget. They try to produce as much as possible rather than producing like really top end stuff, like Disney would, for example. And Magic the Gathering cards are an interesting one as well. In that potentially they're a commodity, but also potentially they're not. So that was an interesting one. I had an idea at the time, but obviously I didn't write it down, and I don't remember it in my early morning haze. But the main point there is that it can it's pretty clear with like oil and gas and things that they're commodities. But when you start getting down to this stuff, it can get quite weird. News is another one that's an interesting thing where it sort of is and isn't a commodity. So let's look at what the properties of commodities are. A commodity generally responds to supply and demand. So as prices rise, more will be produced or supplied. For example, I'm currently hunting around for my 0.1 BTC that I got given for free when you could get free Bitcoin from the internet. I thought it might be on my USB stick. But when prices rise, people run around and they set up more commodity projects, or if people have spare storage of the stuff, they sell it. And inversely, when prices go down, they turn off production, or they forget about things. Like you just stick all your gold in your cupboard and you kind of forget about it because it's no longer got any value. The other thing about commodities, particularly things like mining, is as prices rise, resources which can be economically extracted increase. So you see a lot of news articles, and they're like shock news articles, where they talk about, there's a limited amount of iron ore in the world, there's a limited amount of gold, or there's a limited amount of whatever. As the price of that commodity goes up, more of that, more resources can be extracted. For example, there's very minute concentrations of gold in seawater. So if you can process a very large amount of seawater, you can actually extract gold from that. The problem being is that it's not economic at today's prices. But if the price was 3, 4, 5, 10 times the current price, it may be economic to process seawater to get gold. And as prices rise, people naturally look for substitutes. So the example here is in solar panels, silver is used for the backing of solar panels for the mirror. And aluminium is actually a substitute for that. So if the price of silver rises, the solar manufacturers may substitute for aluminium. The reason they use silver is because it's better than aluminium. But when the prices encourage them to go and look more closely at aluminium or a substitute, they're very likely to find a way to make it work. Another interesting one is oil is actually a substitute for LNG. And you can see this. I took a snippet of a news article very recently. There's been an LNG. The world basically ran out of LNG production during the winter in Asia because a lot of it was shut down, and LNG can't easily be turned on. Or you can't. Once you hit the max cap for production, you can't. In a week, you can't set up more production of LNG. So the Japanese, because the price of LNG was so high, they switched on all their fuel oil power plants and started burning fuel oil, which is like hugely polluting, rather than paying over top prices for LNG, or they probably couldn't get LNG at all anyway. The other interesting property of commodities is cost savings from innovation flow to the consumer of the commodity products rather than to the supplier of those commodity products. And I'll show you why that happens in a minute as well. Short-term price fluctuations are worn by the producer. They're hard to pass on, which sort of flows on from this one above. So in a really hot commodity market, in towns where a lot of that commodity is being produced, you end up with price inflation, wage inflation. These places can end up like really hot in terms of pricing in that particular local area. Australia is an exact example of that. During the commodity boom in 2007 to 2012-ish, wages here were dumb, house prices were dumb, everything was just through the roof. I don't know what you guys pay for a coffee, but the average coffee price here in 2010 would have been about $5 Australian, and the Australian dollar was 1.1 freedom dollars, so it was above the US dollar. And short term, the price of a commodity can actually fall below the economic cost of production, i.e. the operating expense plus the capital expense, and to even below the operating cost, just the operating cost by itself. And we saw this last year with oil. It actually dropped below the operating cost of production briefly. In an efficient market, the long-term average price should be the marginal cost of producing that commodity, unless there's some sort of structural issue. But that's I put a lol there because that's what's called a spherical cow, and I'll explain that in a minute. And the other question here is, what would you expect to happen with jewelry if the price of gold rose? And this is another interesting one. It's sort of a substitution, but I don't know if you've ever heard the saying that when you buy a ring for your wedding, you're supposed to spend 3 months' salary. They don't say you're supposed to go buy 3 carats of gold. They say you must spend 3 months' salary. So what that actually means is the concentration of precious metals in your jewelry moves up and down with the price inversely to it. So as the price of silver rises, they're likely to decontent the jewelry to match the market, so that it's 3 months' wages or something like that. That's sort of a general concept. And the long-term competitive advantage in commodities are lowest cost and access to capital. That's like it. And there's not a lot of moats. The economic term there is competitive advantage. So I just want to run into how the difference between CapEx and OpEx, because this will come up later. But capital expenditure is predominantly upfront, so it's the cost of setting up the processing plant. If you're talking about mining, it's digging to the ore body. So the ore body might be below, like a certain number of meters below the surface, and so you've got to dig out all that what's called waste. It would be the cost of any sort of infrastructure that you have to build, and the exploration cost of finding the ore body and all that sort of stuff. So that's capital expenditure, and for resource projects in particular, capital expenditure is a very significant expense. And then operating expenditure is just the day-to-day. Once you're actually digging the stuff up, operating expenditure is what you're paying today, the cash outflow going out today. For digging up. So that's usually on a unit basis. And I'll give you an example later on, but in oil and gas, for example, the operating expenditure, i.e. the amount they spend day to day just to pull it out once it's already constructed, it is very low. It's they're paying for the electricity to run the pumps, basically, and then the dudes that make sure the thing doesn't blow up. That's basically what they're paying for. And what you need to know is prices can fall below this operating expenditure number, and often they're below this capital expenditure number, because in theory, for a project to be economic, it needs to be basically the sum of the capex plus the sum of all the operating expenditure for the lifetime of the project, split up against that production. So prices, these are sort of lower bounds, in that if it starts falling below these numbers, if it falls below the capex plus the opex, then people aren't going to make new projects. If it falls below the opex, people are going to go broke. Is basically what happens. So prices can fall below those, but if they fall below these, this is actually a really good trading opportunity, because it's not economic. It can't last, basically. And so we saw that with oil. It goes negative. That's a classic example, because effectively what was happening there is, with a barrel of oil, they were handing over $37 with the barrel of oil. Clearly, that's not sustainable. And that's a classic example, but there's more subtle examples of that. But oil is just the best one, because it's just funny as hell. So, given some of the things I've just said, in that it takes long times to bring projects online and all these sort of things, commodities go through a cycle, which go back here. I drew this very poor paint diagram. This is the big black line is the commodity cycle, and it doesn't look as neat as that, but and the thin black line is the stock price of any sort of resource company, and it moves around this commodity cycle line, and that's related to the factors related to that particular mining company. So the commodities move through a commodity cycle where they're overhyped, and then at some point it flips, and then they become very much underhyped, and everyone hates them, and no one wants to talk about them. And the cycle is due to institutional dynamics and information asymmetry, plus the fact that it takes forever to bring large resource projects online. So an LNG plant, for example, takes 4 years to build, and probably another 3 years before that to plan. New mines your reserves are always declining. In mines and oil and gas companies, like your deposit just it's non-renewable, so you dig it all up and it's gone basically. Grades decline, and they tend to mine the cheapest stuff first because it's cheap. And so grade is the concentration of the economic mineral, the economic mineral in the ore body basically. So the concentration of gold in the ore body declines over time. Just as that's how mining works. In oil and gas, your pumping rates decline. So I'll show you a graph of that later on. And projects take many years to bring online. LNG is the classic one, but even iron ore mines take 5 years to build a proper at-scale iron ore mine. But yeah, what it all means is that the markets oscillate between oversupplied and undersupplied, and so we can have a look at that. There is a Q&A at the end. I just saw that. Feel free to ask me questions at any time, and I'm trying not to pay attention to the Discord because it distracts me. But I just saw that question. What particularly didn't you understand on the capex and opex? I mean, I'll stop here if someone wants to ask questions, and then we'll keep going. Okay. So I mean, I'll have another go at explaining it. So capital expenditure. If you're building an LNG plant, your capital expenditure is basically you're paying people for 3 years to plan a project which isn't producing any money. You're then paying people to build that project, which takes 4 years, which you're still not earning any money on that project. That is not actually considered to be expenditure if you look at the financial statement for one of those LNG projects, none of that would be classified as expenditure, and they wouldn't make a loss relative to the size of those projects. So, like an LNG plant, one train, I think Cheniere is the one that I'm thinking of. It's got a 27 megaton per annum series of trains. I think it's got like 9, and it costs around about $30 billion to make. So most of that has been spent to today, but they didn't declare a $30 billion loss because they spent all that money. It actually gets capitalized as capital expenditure, and then they amortize that expenditure against the production over time. Whereas operating expenditure, I'll show you operating expenditure specifically, but that's the day-to-day cost of actually extracting the commodity when the project is running. So if you're talking about a mining company, you've got to pay for the fuel for the trucks, you've got to pay for the maintenance for the trucks, you've got to pay for the guys running the trucks, you've got to pay for transport to shipping. They do estimate the OPEX for mines that are not running yet. That is generally in the financial forecast. They will actually predict how much it's going to cost because it's usually pretty easy to predict those sort of things. And same with CapEx. They run around getting quotes from everyone. Yeah, some of this it might become clearer later on about how this applies to the commodity prices. So just bear with me, and it might become more clearer. But I needed to explain those particular terms so that you're aware of what they mean. A lot of people don't understand the difference between the two. So yeah, there's a commodity cycle. Basically, commodity prices go through this cycle over time, and 2010 was sort of a peak. 2010-11 was a peak of the commodity cycle, and then by about 2014, we were back in the dumps. Everyone hated gold, everyone hated oil, everyone hated iron ore. It was just the pits. Now it looks like a lot of commentators are talking about the fact that we're now heading into another commodity super cycle. I don't know how true that is, but it's an interesting theory. So now what I'm going to do is I'm going to show you most of this stuff comes from macroeconomics. So I'm going to show you a bit of macroeconomics, very basic macroeconomics, and I'm going to show you a bit of systems dynamics because that's relevant as well. And I'm going to explain a couple of interesting things. So I don't know if you've ever heard of a spherical cow, but a spherical cow is it's a joke. And the joke was that milk production at a dairy farm was low, so a farmer wrote to the local university asking for help from academia. A multidisciplinary team of professors was assembled, headed by a theoretical physicist, and 2 weeks of intensive on-site investigation took place. The scholars then returned to the university, notebooks crammed with data, where they began writing a report and left it to the team leader. Shortly thereafter, the physicist returns to the farm, saying to the farmer, "I have a solution, but it only works in the case of spherical cows in a vacuum." And basically what the joke here is that most, in terms of understanding commodities, you use models basically to do it. The problem is that models are never perfect. And that's the joke here with the spherical cow, is that this model that the physicists had come up with is clearly not suited to the farmer's situation, because you can't get spherical cows in a vacuum. So there's no point in that model. So what you need to know is that anytime you're using a model, there is always some error. And you can still use the model. You just have to understand where those errors are and when the model is inappropriate. In economics, one of the biggest sort of spherical cows is all other things equal. You'll see economists say this, which basically means that they draw pretty graphs and things about where things are going to go and what's going to happen and all this, but there's always an underlying assumption of all other things equal, which is never true. So there's always some error. And this is why. The markets are dynamic systems. So what a dynamic system is one with feedback loops, and what that means is a feedback loop is your action today causes the actions that people take tomorrow to change. And that's a dynamic system. So if you go and buy gold today and push up the price, someone may not buy gold tomorrow because the price is above their buy price. And so it's this dynamic system where your actions influence the actions in the future. Chaos theory is an example where, the butterfly flaps its wings and then Hitler is never born. That's a dynamic system. And there's a nice diagram here, this is systems dynamics diagram, which shows you how you can actually model dynamic systems. And you can see this is a very simple diagram, but it shows how it's a product adoption diagram. It shows how potential adopters become adopters, and then how they feed back into each other via feedback loops. And so you can understand this intuitively. Imagine when the iPhone came out, the first year I think they only sold 1 million phones. You go and buy one of those first 1 million phones, and then you're like, "Oh, this is pretty cool," and you tell your friend, and your friend's like, "Oh, I want to buy an iPhone," and then he tells 2 of his friends, and they tell 2 of their friends, and so on and so forth. And so the more adopters there are, the more of those potential adopters adopt it because they see their friends have it. And so that's a feedback loop, and it looks exponential in the early stages, but it's not. It's an S curve. And markets are a dynamic system in that if the price of silver goes up, then people are going to build more silver mines, or they're going to find a new way to extract it, or they're going to pull it out of their closet and sell it. If the price of silver goes down, people are going to stop looking for it. They're going to stop making new projects, and it's going to have a natural break on that decline. And there's always a joke. Economists have successfully predicted 9 of the last 7 recessions, and the problem economists have is they can only be right until everyone realizes they're right, and then they can't be right anymore because the system adjusts to the fact that they are right, which kind of sucks if you're an economist. Which is why they predicted 9 of the last 7 recessions, because if they predict it correctly, everyone adjusts and the recession never happens. This is a bit more about feedback loops. So there's 2 types of feedback loops. There's a positive feedback loop and a negative feedback loop. It's very rare to see a positive feedback loop because it's unconstrained growth. So you can't have unconstrained growth, because at some point, if we are perpetually just forever eating all the food, like always growing, eating more and more food every year, then eventually we're going to eat the whole earth. So that it's not sustainable. So there's always some upper limit that holds it back and creates some sort of negative constraint on a positive feedback loop. So the main point there is, if you ever see a positive feedback loop, you should never assume that it's actually a positive feedback loop or it doesn't have some upper limit. And I've got a couple of examples here. So a positive feedback loop would be an unconstrained population growth where we're all immortal. So we only added new people to the population. Initial naive modeling of COVID assumed a positive feedback loop, i.e., they took the R, I think it's the R number, and then took the population at today and said, okay, and the number of sick people, and then just took the R number and then assumed that applied it forever without any constraint. And next thing you know, the whole world's got COVID in a month. But that's not what actually happened. What actually happened was it did have an exponential growth rate, but the world reacted to that, and they had social distancing and they had lockdowns, and we've now developed vaccines. So there was a natural break on that exponential curve. So this is the key point here: is anytime you see something that looks exponential, assume it's a logistics curve, which is an S curve, and try and predict what the limit of that curve is. And that there's a concept called mean reversion, which is that things tend to revert back to the average over time, and this is the fundamental basis for that, is that there's always these limits everywhere. I've put a little link down here. You can go if you want to go actually learn about systems dynamics. It's got some cool software to play with, and I've played a lot with that stuff. Facts just suggested you just need to tell people to inverse your plans, and that's right. Yeah, if you're an economist, it depends on what your objective is in telegraphing your predictions. But if you just want the kudos of being right, well, then you kind of want everyone to understand that you're right. But then once they figure that out, they're going to realize that once they figure it out, they're going to go, okay, this guy's right, and they're going to actually make him wrong by everyone realizing he's right. So it's kind of this self-defeating thing. Cool. Now we'll get into the actual modeling. So this is really basic macroeconomics here. So economists assume supply and demand are always trying to be in equilibrium, and they draw this pretty graph here, which is a supply-demand graph. And this is a very spherical cow. And what this chart shows you is that they never put any prices on this sort of thing because it's not accurate to that level of detail. But what it allows you to do is look at direction, basically. So what you have is a demand curve. So that's the demand curve there. This is a supply curve. And from this, you can assume this is the quantity that will be supplied at that price, or this is the quantity that will be demanded at that price because we look at this curve here. And from it, we can then use this graph to look at what happens in certain scenarios to prices and quantity. So let's say we implement a new technology. If you implement a new technology that improves the cost of production, what it actually means is your supply curve moves this way, which means your price goes down. You've got a new equilibrium price here, and this is the new units that will be supplied. You'll notice I've written down here, it assumes ceteris paribus, which is all other things are equal, which is that spherical cow I mentioned. Tariffs are another one. Tariffs are a classic in that tariffs cause what's called a deadweight loss, which means they're bad for society from an economic standpoint. Or they're theoretically bad anyway. So this is a supply-demand graph for a particular country, and then it shows you the world supply and the tariff applied and things like that. So what you can see from a tariff is this is sort of the equilibrium point for a particular for the world, basically, right here, and the country could produce at these prices here. So they would produce they would produce at P1, but then they apply a tariff. So now they produce at P2, and the quantity is now is here. I feel like I'm not explaining this one very well, but you can analyze tariffs on here. You can analyze what happens with new tech. You can analyze with structural shifts due and like all sorts of things. The main point I wanted to show here was what happens when demand outstrips supply, which this sort of thing happens in commodity markets, in particularly resource commodities, every now and again, and also the inverse happens where supply outstrips demand. So when demand outstrips supply, pricing is no longer based on marginal cost, which I'll show you what the marginal cost is in a minute, but it gets priced on marginal demand. So if you're looking at this supply demand graph here, this is the supply and this is the demand. So if you're demanding more than can be supplied, so Q is some sort of constraint, so we can only produce up to this red line here, that means the price has to be here at B, because that's the only way that you can actually be priced. It's not going to be here because everyone's going to want it. So it's somewhere, the price has to be somewhere up here. It's not actually going to be at B, it's going to be somewhere in here. As all these people are prepared to pay that price. And we can only produce this. Obviously, what this actually means is if you ever hit up against one of these constraints, the price very quickly goes from this equilibrium price straight up to here. And yeah, like I say, these are great trading events to capture. So oil is a classic here, and I'll show you an actual graph for oil in a minute that shows you this effect, because it happens, like oil, for some reason, it happens all the time in oil, where it either gets oversupplied and they can't sell any more oil and the price crashes, or it gets undersupplied and the price shoots to the moon because there's nothing more can be supplied, but everyone wants to buy it. And so you get these jumps from pricing from on this curve to pricing on that curve. The other one you need to understand is elasticity. So you'll see that the angle of these graphs, that's referred to as elasticity. So if we look at price elasticity of demand, you've got it's the capability of the market responding to changing prices. So it's highly elastic if the price doesn't change in response to the change in demand. So it doesn't change much in response to the change in demand. And conversely, it's inelastic if the price changes a lot in response to the change in demand. So you can understand taxi plates are very inelastic in that a lot of states and jurisdictions have taxi plate quotas. A lot of taxi plates states have taxi plate quotas, i.e. there's only a very limited number of taxi plates that exist, and it doesn't matter what the price of those plates is, that's going to be the number of plates that exist. So taxi plates, for example, I think in New York, last I heard, they were selling for $250,000 each. So to run a taxi, a yellow cab in New York, it costs $250,000. Obviously, that's been crushed by Uber, but that was taxi plates themselves are very price inelastic, i.e. it doesn't matter what the price is, there's going to be the same number of taxi plates, which if you look at this is fixed here. And so the pricing is going to move according to demand only. Take oil. Oil, it's very hard to set up an oil project very quickly. So the supply is very inelastic in the short term. So the price can move very fast in the short term. But it's semi-elastic in the long term because you can build new projects. Netflix, on the other hand, is almost perfectly elastic. It doesn't matter how much is demanded, Netflix will always supply it at $10 per month. And cheeseburgers are probably elastic in that Mickey D's is probably going to change their pricing depending on how many they want to sell. So if we go back to this graph here, this is the supply curve, and this is what it looks like in sort of more detail. So this is an iron ore. It's called a marginal supply curve. And the way this is actually done, it's actually a curve. So you can see this curve's like this. They take all the producers and then line them up. So this is Rio Tinto, which is one of the world's biggest iron ore miners. They can produce, according to this graph, and I think this is very out of date, they can produce iron ore at $40 US per ton. and they produce about 200 million tons. So they line that up, and then they get BHP, which is the next highest cost producer, and so they line that up, and so BHP produces a bit higher, produces a bit less, so we're now up to 590, and then so forth and so on. The big ones are obviously the big ones, and then these small ones are just all smaller producers, and they've just coloured them differently. They just haven't named them. So, if the world price is at $62 or something, that means all these guys in this side of the curve are fine, right? They're not going to go broke because effectively Vale's profits, for example, are this bit up here. And if FMGs are here, but if the world price moves down to $40, well, suddenly FMG is making losses and all these guys are going broke. And so this is a marginal supply curve, which is it's sort of an actual application of this, and so that curve sort of mostly fits in this section here. And this is how you actually analyze what's going to happen with miners and things like that. Is obviously if you own a miner up here, it's basically going broke unless you expect the price to go through the roof. If you buy a miner down here, it's not going to respond that dramatically to changes in prices because it's already making all of this profit. I've said here, I've said it's a theoretical concept. This is someone actually went and tried to put together a marginal cost curve for iron ore miners, and good on them. But when you see one of these in real life, you've kind of got to assume that this is one graph, and there's probably about 10 pages of 8-point font assumptions associated with it. The problem with iron ore, for example, is most of Rio Tinto's and BHP's mines are in West Australia. Vale is in Brazil. FMG is in West Australia. A lot of these guys are in China. Most of them are shipping to China, and so there's transport distances involved. And there's exchange rates involved, the Australian dollar here and the Brazilian real there and Chinese funny money in here. And there's other iron ore miners in Africa and things like that. And so you've got all these different exchange rates that flow into it. And then you've got taxes and you've got cost of labour and all these different factors which kind of have to be assumed in this. And it's a point-in-time snapshot at a particular place only. And then it changes over time. And I'll actually show you some changing marginal cost curves over time later on. The other interesting thing is when demand falls off the edge of the supply curve, so it's over here, so i.e. the price gets up to $140, there's no more suppliers. So the price doesn't stay at $140. It can't. It gets priced at marginal demand, which means the dude that's prepared to pay the most for all of this is the guy is the guy that's going to get it. And so the price doesn't stay at 120 at this point or whatever it is. It actually shoots up and it goes to marginal demand. And then there's another one of these curves which you can't get them. Well, I've never seen one anyway, but you imagine it as the equivalent of this. And so Rio Tinto is selling to Chinese steel mills. So Chinese steel mills, there's going to be a Chinese steel mill that will pay $160 a ton, and there's going to be another one that pays that's prepared to pay $150 a ton, and there's going to be another one that pays $140 a ton all the way down to here. And this guy, whoever this guy is over here, he's the guy that's going to set the marginal demand price. The other interesting thing is this makes it look like Rio Tinto's pricing for all of their production is flat. It's not. Rio Tinto actually has a curve of their own. So Rio Tinto, last I checked, has 20 mines for iron ore, and they'd be able to line them up according to cost, exactly like this. And so if Rio Tinto has to cut production, they're obviously going to cut the ones over here. The other interesting thing about that is even within those facilities, they actually have the capability of moving that cost by either doing what's called high grading, or they can do other cost type saving initiatives to try and change the cost of individual projects. So you've actually got a curve in here itself in each one of these little companies. The other thing that people naively do is they go, okay, $62 a ton, this guy here, this tiny little guy here, he's not going broke. That's the theory anyway. But what they forget is that FMG, Vale, BHP are all building production, and their boxes are going in this direction and pushing the entire curve this way. And so this guy here, who's just breaking even, he's going to go broke because the current price is going down because that's all that's being demanded here is 1,200 megatons per year. Marginal supply curves are like one of the key things to understanding how commodities get priced. So that's why I'm spending quite a bit of time here. The other interesting thing, which I think this is possibly the example, the end of the theory section, is byproducts. So byproducts are very common in the resource sector. In the case of oil, a byproduct is gas. So they pull out the oil and they get gas with it. And a lot of the time they'll flare it, but if they can, they'll try and sell it. But it's only if they can. In zinc, lead mines, silver is a byproduct. So they're not targeting silver specifically, but they get silver with it. So if you're talking about gold, you often get silver with it. They would be targeting gold, but they get silver. Copper commonly produces gold and silver. So you're targeting copper, but you get gold and silver with it. And sometimes it's like a 10-to-1 ratio for copper to gold. Cobalt is produced with nickel. Gasoline was a byproduct at one point, i.e. the stuff you put into your car, oil refineries used to dump into the river, or they burnt it off, or they flared it. And I'm talking like 1800s here, not any time recently, but that was considered a byproduct if they figured out they could use it in motor vehicles. Some rare earths are byproducts as well. And the other interesting things is this one is really interesting. Iron ore commonly comes with impurities. So the grade of iron ore is if they're digging up a ton of the stuff, it's mostly iron ore, like most of it's going to be iron ore, but it contains some impurities. And so impurities might be vanadium, phosphorus, sulfur, manganese is commonly an impurity. And depending on the price of those byproducts, skarn is a geologic formation. Depending on the price of those byproducts, the mine can actually switch from an iron ore mine to a vanadium mine with iron ore as a byproduct or vanadium as a byproduct. And this actually happened particularly with vanadium because vanadium is priced at about, it was at one point $100,000 a ton for vanadium, whereas iron ore was $100 a ton. And there are vanadium mines that are, it's mostly iron ore they're pulling out, but they're pulling out about 1.5% vanadium. So as the price of vanadium moves and the price of iron ore is about $100, $150, what they're targeting changes because they're looking for the iron ore or they're looking for the vanadium, and it's whichever one gives them the most profit. Basically, is what they're going to target. So you get this weird situation where sometimes a mine is an iron ore mine and sometimes it's a vanadium mine with iron ore byproducts. So that's a really interesting situation there. In times like today, where everyone's excited about silver, they will. Your junior miners will say, "Hey, we're a silver mine," and then you go and look at the commodities price, their resource statement, which explains how much they have of each, and most of it's going to be in the other metals like zinc and lead. But they're talking about silver to capture some of the zeitgeist, i.e., get people to look at their mine, basically. So now I'm going to run into an actual example of how to look at oil, so you get an idea of how all this theory fits together. So oil is obviously a commodity. It's inelastic in the short term. 2008 was an example of undersupply, and you can see that here. You can see the massive increase in oil demand. And so this was China, the change in Chinese demand in 2007-ish. China had obviously been building up, but they really ramped up here. And it basically fell off a cliff. There was no more supply to be had. There was actually talk of peak oil and all these sort of things. And there was more demand than there was supply. So this is $150 a barrel. The cost of production at the time might have been $100. There'd been underinvestment in oil for many years. The oil had been priced at $20 a barrel, and Saudi Arabia reportedly produces about 10, which is the cheapest producer in the world. And oil got priced at marginal demand for a brief period. it got priced on the basis of how much people were prepared to pay for it, not how cheap it was to supply. And 2020 was an example of oversupply, which is this example here. Oil, there's only so much storage available for oil. So when you pump it out, it's got to go somewhere. And what happened in 2020 with COVID is there was an oversupply of about 10 million barrels a day was being oversupplied, and that had to go somewhere. And once storage filled up, the oil guys had to shut down production, and that's what actually happened. But for that very brief period of time, it went negative because the whole pile of people had written contracts to take delivery but didn't have capability of storing it. And so they wanted to get out of those contracts as quickly as possible, to the extent that they were basically giving away free oil, which is great if you magically happen to own a oil storage facility with spare capacity, because you could take a whole pile of free oil and get $37 for the per barrel for the privilege. Oil pricing in a free market is very volatile, and what that means is most of the cost of producing oil is in the capex, is in the capital expenditure portion. The operating cost of running an oil well is next to nothing. So Saudi Arabia produces oil on an operating cost basis of about $5 to $10 a barrel, whereas the world oil price at the moment is $65 a barrel. Even the shale projects are able to produce it at about $20 a barrel. And shale is considered to be sort of one of the higher cost production methods. And so oil pricing is controlled via a cartel. And this is kind of, it's been done, it's illegal to run cartels, but well, in the US it's illegal to run a cartel. In my country it's illegal to run a cartel. But it is kind of reluctantly accepted in oil, because the alternative is even worse. Oil goes from hugely oversupplied to hugely undersupplied, and the market just gyrates between the two, and suddenly we're all driving cars or we're not driving cars, and it's just not good for it's not good for global stability, basically. Because if suddenly you've gone from having really cheap oil and bought a car and all this sort of stuff, and you're driving 30 kilometers every day and all this sort of, or 30 miles if you're American, 30 miles every day, and then suddenly the price of oil shoots through the roof, you're going to have this huge expense, and you can't defray it very easily. And that's not a good situation for everyone. So we're better off having stable prices over time. We're better off having $60 a barrel, which is why OPEC is the current cartel that maintains the oil price. Prior to them, they had what's called the Seven Sisters, which were Exxon, Chevron, and their ancestors. They've kind of merged over time. And most of those ancestors came from Standard Oil, which was the big conglomerate. And Standard Oil was actually managing the price of oil for a very, very long time, until they got broken up in the early 1900s. So that means the price of oil tends to stay fairly stable until it gets to the marginal supply or demand situation, and then the cartel loses control over the pricing, and then it's on for young and old. And so here, the cartel lost control of the pricing, and so it shot through the roof. And here, the cartel had no way of controlling this pricing, so it collapsed. The cartel actually lost control over here, in that I think Russia and Saudi Arabia started having they basically threw out the rule book and all started pumping as fast as they could, and the price tanked. And I think it was about $20, $30 a barrel here. And so this gives you, I've been explaining it, and this actually tells you all the numbers I was probably explaining. This section here, I've actually dug up ExxonMobil's 2007 report. And so if you're looking at the pricing here was $150 a barrel, Exxon was producing it at $10 a barrel. And you can see the pricing isn't that much dramatically different. Although, that's still an increase, but the price of a barrel of oil was, $60 a barrel, $40 a barrel. So they're able to produce it really cheaply on an operating basis. But if they have to go and build a new project, they'll be paying $60, $70 a barrel to produce, to set up that project initially, to drill the well, to put in the platform, to put in the processing plants, all these sort of things. The other thing is shale didn't really exist in fracking. If anyone's familiar with fracking didn't really exist in 2007, and it was only really they're still trying to figure out the kinks, and so it was $100 a barrel to produce shale oil. Now I've heard that on an all-in basis, they're now running at about $60 a barrel to produce to set up a shale project, and the operating costs are very, very low. And this is a production curve for oil, so this helps you understand what happens to the supply over time if no new projects are set up. So Eagle Ford is a particular region that produces oil. This is the region down here in Texas. And what this chart is saying that is, if you drilled a shale well in 2007, or if you just drilled an oil well in 2007, this is what your production project profile would look like. So you'd have a little peak, and then it would go down. If you then produce if you drilled a well using 2015 techniques, what you should expect is that it would shoot up to 450 barrels a day, and then it would decline very rapidly. Within 12 months, you would be down 75% of your production. So you're going to produce most of your oil in the first 12 months. The net thing here is that if you don't keep drilling, production declines very rapidly on a countrywide scale. And you can actually see this. I don't have the graphs here, but there's the Baker Hughes drill rig counts. Due to this pricing here, or the fact that they couldn't supply any more oil into the market, the drill rig count just fell off a cliff. There was 1,200 drills active up here, and by here there was about 200 active. So people just stopped drilling. Subsequently, you can actually see what happened to. That's the net imports. That's production. We don't actually have what happened in 2020, but production in America was roughly at its peak about 13 million barrels a day, and I think it's roughly running at about 10 million at the moment. So it's dropped 3 million barrels, and it's predominantly just due to this effect here, where within 12 months you're down to only 25% of your peak production. Conventional oil, the other thing is these look like shale oil curves to me. Most of the onshore oil production in America now is shale oil, fracking. Whereas a conventional reservoir, which is sort of the traditional, if you've ever seen the movies where they drill a hole into the ground and then all this oil shoots out the top, that's a conventional oil field. And that is tends to have a much better production profile in that it doesn't dramatically drop like this. It's more like a curve that looks like this, much nicer curve. And what's the other thing about conventional oil that I need to mention? They don't do fracking and all those other fun things that gets up people's nose. It's also a lot cheaper to set up a conventional oil well. This is where the marginal cost curves for oil. So you remember I showed this is the iron ore curve. This is the equivalent for oil. And I think this isn't for the world. I think actually no, this looks like it might actually be. This might actually be. Not sure what it is, but it doesn't matter. What you need to understand is that this is what marginal cost curves look like. Oil has so many producers, so many wells that they didn't really bother to try and figure out who they were. They just sort of kind of threw the curves on there. But you can also see here how the curve is moving. So theoretically, if the price shot up to $140 a barrel, the world in 2019 would have supplied 12 million barrels per day. Today, if the price shot up to $140 per barrel, or in 2017, it's 2019 just here, sorry. In 2019, if the price shot up to $140 a barrel, we would supply 40 million barrels. And so that's these marginal cost curves help you understand what's going to happen as the price moves down. Because if the price shoots down to $40 a barrel, and we're talking about 2019, in theory, on this graph here, we should only be supplying 7,500 barrels. What actually happens, though, is that the dudes over here who are losing money they hold on, hoping that they don't have to shut down and the prices go back to regular. And there's this kind of game of chicken going on, and who's going to shut down first. And so what actually happens in the short term is prices go way below what is actually economically profitable at that demand level. So you get this sort of overshoot effect. And so you can kind of see that in this graph here. I don't have the forward graph, but everyone knows oil's been shooting back up. This is an overshoot here. It shoots way down and it kind of goes up. You can see it again here, where it shoots down and then it kind of goes up a bit. Kind of a relief rally is, I think, what they call it, where there was not a lot of demand around here. It didn't really change, and then it started going up as lockdowns ceased. So we've looked at sort of the general overview of oil. We've looked at the sort of production dynamics. So it costs a lot to set one up and not much to run it. We've looked at how production changes over time. We've looked at what the marginal cost is, and now we look at who's actually buying the stuff. What are they using it for? So it's pretty obvious to people for oil. We use it for cars, planes, ships, chemical feedstocks, so plastics and lubricants, and electricity generation. And this is kind of this is the stats I could find on it. This is the stats I could find on it on what it's actually used for. So if we're talking oil, 56% is used for transport, 5% is used for other industry, 5% for power, 14% for chemicals and other and buildings. I'm assuming this is heating for buildings. We don't actually have oil heating in Australia, but I understand that certain parts of America actually use oil for heating, or something like kerosene or something. Then you can look at how is this demand going to change over time. So if you imagine this is the supply curve, so we know that we've seen that supply has been heading in that direction mostly, and now it's kind of come back a bit. How is demand going to change? So the classic one is everyone knows that the world is going electric vehicles or hydrogen vehicles. So we'd expect that this segment would be in decline. I don't know what other industry is. I know power is going to get killed because renewables will take its place, or hydrogen will take its place. Anyway, so we know that at least this segment and that segment is going to get killed. We know if this is heating oil, most likely it'll get killed at some point. And then so you've got these two segments here. So you've got 30%. Chemicals is a really complicated one in that it goes into so many things, and I don't have a good answer here. But to date, I believe it's been growing at a 3 to 5% per year as we use more plastics, demand more lubricants, and all the other interesting chemicals you get out of petroleum. But then you've also got gas demand, and gas demand is growing like crazy. LNG demand is an example, which is LNG is just gas from America that's been shipped overseas. World LNG demand grew by 10% in 2020. So the world's in a pandemic, and gas demand is still going up. So the question here is what's going to happen to this graph and how quickly. And for oil, I don't actually have that on me at the moment, but it's not as cut and dried as people think, in that oil isn't ending tomorrow. Obviously, everyone's not switching to an EV tomorrow, so this transport segment isn't magically disappearing. The other one about oil is gas is often a byproduct of oil production. So if you look at this is what a sort of a stylized diagram of a reservoir. And what a reservoir contains is it contains some sort of capping rock. Sometimes it's salt, or it's usually a clay. The oil, as it gets produced, oil is generally produced by decaying organic matter turning into oil at high temperatures and pressures. It flows upwards, and then it gets trapped in this capping rock. if you think about the density of gas versus water, oil floats on water and gas obviously floats on oil. So you end up with a reservoir that looks like this. And so what the oil guys are trying to do is they're trying to drill into this black bit, but like a soda can, when you open it, gas comes out. So they drill into this, they get oil, but they also get some gas, which is effectively like the bubbles in your soda can. And they also get water because it's kind of all mixed in together. So the question is, what do they do with that gas? They're not targeting it, but it's sometimes a valuable product. And so what they do is they take the gas and they plug it into, they'll either flare it, i.e. burn it off and just get rid of it because it's dangerous, or they'll process it and try and sell it. But they don't care what price they get for the gas because that's not what they're targeting. They're targeting the oil and they just happen to get gas. And so what happens with the natural gas curve? This is a natural gas curve down here. The marginal cost of dry gas, i.e. where they're just targeting gas as their primary product, is I don't know if you can see it here, but it's about I think it's about $7 a MMBTU, millions of BTUs. But because the associated gas guys, i.e. the guys that are looking for oil and just dumping the gas on the market, they actually trash the price of gas. And so this is all associated gas, which kind of screws all the guys that just produce gas only. But what happens if you stop drilling for oil? If you stop drilling for oil, your associated gas goes down, this curve moves to the left, and suddenly gas prices go up for the same demand. And we've actually seen that with natural gas pricing at the moment. Drilling's gone down, so they're drilling less oil wells, so there's less production of oil, so there's less associated gas, and so the natural gas prices have gone up. And if you look at the gas price during the pandemic, it actually went up. It didn't really go down too much at all. And yeah, the main point here is the real cost of gas standalone is much higher than the marginal cost of gas. Silver is a byproduct, and that's why I actually talk about the gas market here, is because silver is commonly a byproduct. So if you're producing more of the primary commodities like copper, gold, lead, zinc, those other things, and you happen to get silver, what's going to happen to the silver price? So yeah, I think that's kind of where we get into. That's kind of the end of the presentation. I've got here, if you want to learn more about these things, most of this stuff is macroeconomics. So you do an intro to macroeconomics at university. System dynamics is an interesting one. I've included a link here to a self-study course on systems dynamics. You get some neat software and play around with it. I never went and did system dynamics at uni. I just kind of worked through that presentation myself. And particularly for oil and gas, there's this book's quite good. There's lots of books you can read. That's kind of it. I'll open it for questions now, and then we might come back to this one if there's time, but it's already been an hour. Any questions? So in summation, natural gas to the moon. I wouldn't say it's that clear. Mainly what I was trying to set out is a general sort of high level how you would go and look at a particular commodity market. I know oil particularly well. But if you're looking at, say, the silver market, you would look at what is it used in, how much is used, how much is produced, where is it produced, what does it cost to produce, what does its marginal cost curve look like, and what does the future look like for silver production and consumption. Yes, CapEx. So the question here is, for CapEx, does that include initial investments like buying land, surveying, etc.? Or is it just the cost of producing the mine extraction? So CapEx is only the initial investments, the buying of the land, the surveying and things like that. The cost of actually extracting the mineral itself, when they get to the ore body, is operating expenditure. No, LNG is not a byproduct of gas. LNG is just liquefied gas. Are there any key terms or sections of filings I should look for in regard to where a company wants to shift their focus from a main product versus the byproduct? Generally, it's in their marketing type presentations. So the presentations they'll give to industry conferences, they'll suddenly start talking about silver and kind of ignore, the gold portion if gold's in the dumps. It's just how they position themselves to the market. Yeah, the correlation between gas and oil, that situation exists elsewhere. Silver is actually a classic where it exists, because silver is a byproduct of so many different other mining processes. But it would definitely exist elsewhere. Is the gas byproduct really that big to affect the market? Yeah, it is. It's very large. The flaring is a huge issue. So where they can't sell the gas, they just burn it, and that obviously creates a lot of emissions, not just in terms of greenhouse gases, but you get pollutants as well. The graphs all come from Google Images. So I just typed in particular economic words, so like marginal cost curve, and I stuck oil in front of it, and I got that marginal cost curve graph. The reservoir one, I would have just typed in oil reservoir diagram and then just picked the best looking one. Yeah, it makes you seem really smart, but in reality, I just sort of went through Google Images. Yeah, it's definitely possible to graph demand just as supply was graphed. Your challenge there is getting an understanding of how much the so if we take iron ore as an example, the people purchasing the iron ore are steel mills. And so how do you understand what the marginal price is that a steel mill would pay? And the answer there is they're not going to tell you. So you would have to go and look at the economics of that particular steel mill, at how profitable they are, and then kind of guess at what they'd be prepared to pay. Yeah, sure. So the question there was, can you go back to the price elasticity of demand? So the question here is almost like how countries like Saudi Arabia need oil at a certain level to maintain their budgets. That's kind of a meta issue in that Saudi Arabia uses their oil revenues to fund their state budget, but the two aren't linked. Saudi Arabia's budget is, they're basically taking all the profits from their oil company and using that to fund their budget. Their problem is that if their budget kind of doesn't match reality, it's their budget that has to change, not the oil. If you know what I mean. Because, for example, if OPEC set the price at $100 a barrel, Saudi Arabia only actually has control of their own oil production. They don't have control of world oil production, and even their cartel members tend to cheat. So if they set it at $100 a barrel, there's going to be a lot of incentive for everyone to cheat, i.e. sell as much oil as you can. And it's going to have it's not going to achieve what they're hoping to achieve. So they have to be careful about how they set prices in that cartel. Saudi Arabia would probably, I think I've heard lots of stories about them setting their budget at $100 a barrel or $80 a barrel and all these sort of things. But realistically, they kind of have to make their budget match the oil price and not the other way around. Which poses an interesting problem because a lot of Saudi Arabia's budget is a welfare budget, so they're giving people the equivalent of unemployment, one way or another, I believe. So if they if they have to reduce their budget, they give people less money, the people are going to get cheesed off, and suddenly you've got civil unrest. So it's Saudi Arabia's very interested in keeping a stable price for that reason. And so why did you want me to go back to this price elasticity of demand? Oh, taking notes, right? Yeah, I mean, I can give you the slides if you'd like. So Norway is an interesting case. Norway, there's a thing called Dutch disease, and what happens is in a small economy which suddenly finds a resource project. So the example here is the Netherlands. Netherlands found a big gas deposit off the coast, and suddenly it was a significant part of Netherlands GDP. And what they found was that when they developed this resource, it had a dramatic effect on their exchange rates and hollowed out the rest of their economy. Australia actually has this problem as well, in that particularly over the last 20 years, Australia has become more and more resource focused and less manufacturing and sort of downstream type industry. There's less and less of that and more resource focused. So what Dutch disease is the simple fact that you're getting a shitload of money from oil and gas. It crowds out all the other industries, and those other industries disappear. So you lose your manufacturing, you lose your high-tech industries, you lose your downstream processing type industries, and you just focus on the oil and gas production, which is not good, because if that resource runs out, suddenly the economy's fucked. So that's called Dutch disease. Norway set up, they realized this, and it's very smart of them. They realized this problem, and what they did is they took all the profits from the oil, and rather than using it to fund their budget or using it to give to the people or whatever, they put it all into an investment fund and then invested it. And they did it in such a way that it doesn't impact their exchange rate, so it doesn't have the same effect as the Dutch had. So they're not as, and which is really good for them, because now I believe the reserves in Norway are declining, or significantly declining, and they've got this bucket of money, and they didn't suffer as much from Dutch disease. I don't think they'd get away with not suffering from it, but the reason they set up, it's called a sovereign wealth fund. The reason they set that up was to try and offset the effect of Dutch disease. Australia didn't do that, by the way. Australia's just got Dutch disease like crazy. No, it doesn't mean short Australia. It means you should understand the effects of Dutch disease and what it means for the country. It might mean short Australia, but in the short term, it could actually mean go long Australia, particularly if there's a commodity super cycle coming, because that means the Australian economy and the exchange rate is very much linked to the performance of those commodities. Tiber, I'm not sure what you mean by does the live commodities market differ in any way? In any way from what? Oh, okay, livestock. So, livestock. It's basically all the same theory, but the difference there is your commodities tend to have an expiry date. So, if you don't feed your cow, it dies. If you turn it into beef, obviously the beef has a shelf life of 6 months or 12 months or however long you can store it in a fridge. You've also got a cost of carry of that livestock. So if they don't slaughter it this year, they have to carry it for another year, i.e. they have to feed it for another year, which can cost them money. So those sort of effects have I haven't looked too much into the agri side of things, but they mean different things to iron ore. Iron ore you could just pile up forever and you would never have a problem. Whereas cows and pigs and chickens, you can't pile up forever, so you can't have big stockpiles. It probably means that, just thinking about it, it probably means that the prices are less volatile in those industries. It's also very easy to replenish um, over time, because it's obviously it's a renewable resource in some respect. Of course, the thing that does happen in agribusinesses is swine flu and foot and mouth disease and mad cow disease and all these sort of things, where you can get dramatic price changes, which is what's happening in hogs. You can get dramatic price changes from for acts of God, basically. So yeah, if you can predict a swine flu or a foot and mouth disease or a mad cow disease, then you can make a lot of money that way. Yeah, see how that one holds up in court. Do we have any other questions on all that? I'm intending to do a mining one, maybe a week's time or something. This was a precursor to that because someone asked how to value a mining stock. So, to like I say, to value a mining stock, you've got to understand what the commodity is they're producing and what the dynamics of that commodity are. Cool. Glad you guys liked it. All right, if that's it, we'll leave it there. Thanks, everyone.